Imagine opening your bank account and seeing it stacked with thousands, if not millions of dollars. Sounds like a dream, right? Well, I'm here to tell you that you can make this dream a reality using the strategies I'll share in this video. Let's dive in. 1. The Rule of 72. The Rule of 72 is a golden rule for doubling your money. It's super handy for setting financial goals, analyzing economic trends, planning your finances, evaluating investments, and even managing debt. To use the Rule of 72, you just need to know the interest rate you expect to earn. Here's how you calculate it. Take 72 and divide it by your expected rate of return. For example, if you expect to earn 5% interest, you divide 72 by 5. This gives you 14.4. This means it will take about 14.4 years to double your money. You can also use this rule to see how long it will take for your debt to double if you don't pay it off. For instance, if you have an auto loan with an 8% interest rate, dividing 72 by 8 gives you 9 years. So, it will take 9 years for your debt to double. It's quick and easy to see if you're on track with financial trends. Helps ensure you're making the right financial decisions. You can also use it to calculate inflation. For example, if inflation is at 3%, it will take 24 years for your money to lose half its value. It only works with assets that compound interest annually. It's less accurate for interest rates below 6% or above 10%. Don't let these disadvantages discourage you. The Rule of 72 is still a powerful tool. For a deeper understanding, talk to a financial advisor who can guide you on how to use this rule effectively. Number 2. Compound interest. As stated before, the Rule of 72 only works with compound interest. When you understand the rule and the power of compound interest, you have the secret recipe to financial growth. Having already discussed the rule itself, let's talk about compound interest. The fantastic thing about it is that the longer your money is invested, the greater your earnings will be. In other words, the interest earned on your initial investments is added onto your initial investment, and this cycle keeps going. So the key takeaway here is that to maximize your benefits from compound interest, invest your money and let compound interest do all the work. Now, if you want to know how long it will take to double your current savings, you'll use the Rule of 72. Take your interest rate, let's say 6%, and divide it by 72. 72 divided by 6 gives us 12. This is how long it will take for you to double your money. When it comes to compound interest, the higher the interest rate, the quicker your money will double. You're probably wondering which assets will allow you to capitalize on compound interest the most. So let's get into that now. Number 3. Investments. The Rule of 72 can also be used to evaluate your investments to determine how they will impact the financial goals you want to achieve. Using this rule, you can see if the investments you want to take on will make for a shorter or longer time horizon towards financial success. For us to better understand how this rule applies, let's look at these following scenarios. If you're looking for a safe investment like savings deposits to grow your wealth, we can see that at a 1% interest rate, it would take you 72 years to double your money. This is why saving money in the bank is not an advisable move for those looking to grow their wealth in any capacity. And if you want to ensure you keep growing your wealth, make sure you hit that subscribe button below if you haven't already. Next, there are government bonds. Still safe investments, but they yield 5% per year. At this rate of return, your money would double in 14.4 years. If you have this time frame to wait, then this could be an investment approach to consider. But keep in mind that inflation would take away from whatever amount you end up with. And we will get into that more in a minute. Then there are mutual funds. Mutual funds are a mix of bonds, stocks, and other investments. And typically they offer returns closer to 8%. With the Rule of 72, we can see that an average return of 8% makes our doubling timeline just 9 years. Therefore, with this investment, you can have your money doubling in less than a decade. Finally, there are individual stocks. While stock growth will vary wildly, it's not unheard of for some stocks to appreciate by 12% per year. In this case, your money would double in just 6 years. The point is that you need to assess your financial goals before making any investment. So many people buy assets that are totally misaligned to what they want to achieve out of life. And the example of saving money only to have it double in 72 years is a prime example. However, one of the worst mistakes is not incorporating how inflation factors into your wealth building plan. So let's talk about that next. Number 4. Inflation. You may be hearing on the news that there's inflation right now, but what does this actually mean? An inflation rate is the rate at which prices increase over a certain period of time. Things like household goods and services, for example, are affected by the inflation rate. In simple terms, it costs more to buy the same thing you bought this time last year. The rule of 72 helps us determine how long it will take us to beat inflation. If, for example, inflation averages to 3% year after year, by doing the math we realize that the prices will double in the next 24 years. However, if the inflation rate stays much higher than the Fed's target rate of 2% at say 6%, then your money will be cut in half in 12 years' time. This is why understanding the math behind doubling your money is so important. Without this math, you could be under the impression that once your money doubles, you'll be rich. However, inflation has something to say to that, and I want to share a shocking example to illustrate this point further. From what I've seen and heard, financial planners tend to recommend people invest 15% of their after-tax monthly incomes. The median income right now is roughly $36,000, which after taxes is probably closer to $30,000. At 15%, this means you're investing $375 a month. Assuming a constant investing rate and income, if someone were to invest this amount for the next 40 years at a 7% rate of return, they would be able to amass roughly $1 million. Pretty good, right? Not quite. The problem is that due to inflation, $1 million 40 years from now won't be worth anywhere near what it's worth today. If we assume a conservative 2.5% inflation rate over the course of our example, what you would end up with as inflation-adjusted dollars 4 decades from now would be just over $370,000. Now don't get me wrong, $370,000 is still a ton of money. But is it $1 million? Not quite. This is why you need to perform these calculations to really see where your finances are projected to be down the road. And the rule of 72 does that. The rule of 72 can allow you to identify what rate of return you need to achieve the final result you desire. And from my experience, it's always good to have more money than less. And if you agree, let me know by hitting that like button below. Number 5. Savings. The rule of 72 is great for understanding how your savings can grow. But first, where do you usually keep your savings? At home? That's too risky. In the stock market? It could grow, but there's also a risk of loss. What about a savings account at your local bank? They might offer you 1% interest, but that's not much. Let's use the rule of 72 to see why a 1% interest rate isn't great. If you save $1,000 at 1% interest, divide 72 by 1% equals 72 years. It will take 72 years for your $1,000 to become $2,000. Plus, inflation will reduce the value of that $2,000 over time. Not very exciting, right? Better investment options. We've already talked about better investment options in this video, but you won't invest every penny, so let's discuss when it makes sense to keep money in the bank. Keep enough money in the bank for emergencies. Ideally, have 6 months to a year's worth of expenses saved. This gives you a solid financial base. If you think waiting decades for your money to double is too long, listen up. The best way to increase your wealth is to increase your income. Here's how. Wrong way. Relying on raises and promotions. You might have a bad boss or work for a struggling company. Raises might not keep up with inflation. Right way. Invest in skills that help you make more money on your own. Skills can't be taken away and can earn you more than any employer could pay. The more skills you learn, the more money you can make. Combine skill building with smart investments, and doubling your money will be inevitable. That's it for today's video. If you found this helpful, give it a thumbs up and subscribe for more financial tips. See you next time.